Do you want to become a better, more profitable option trader? I think I have something that can help. I'm Scott Nations. I'm one of the co-founders of Nations Indexes. Recently, I ran a poll on X, formerly known as Twitter, asking how often the S&P 500 option skew diverges, meaning that out of the money put implied volatility goes in one direction on the day, and out of the money call implied volatility goes the other direction. You'll note we're talking about implied volatility or normalized prices at a constant moneyness as proxies for the implied vols we used PutDex, which measures the normalized price of the 30-day one standard deviation out of the money S&P put option, and CallDex, which measures the normalized price of the 30-day one standard deviation out of the money S&P call option. We started calculating both PutDex and CallDex in 2005. And how often have they diverged on a close-to-close basis from January of 2005 to July of 2025? What's your guess? The answer? They have diverged 42.2% of the time. 42.2% of all trading days. Are you surprised? We were. That's right. On nearly half of all trading days, put options are going in one direction and call options are going in another. And again, this has nothing to do with the S&P 500 itself moving. As an aside, I fully admit that I rigged the alternatives that were available in my X poll, but that's because it's so easy to underestimate how frequently this divergence happens. But what does this mean for your trading? The first lesson is that if VIX is the only volatility measure you rely on, then you're half blind. That's because VIX crams nearly every out-of-the-money option listed into that single VIX value, and those portions of the skew can move in different directions, as we've seen. That's why we believe you have to deconstruct skew to understand what the option market is really saying. So if you think you know what's going on with volatility because you know what's going on in VIX, then you're wrong. Think about that the next time you look at VIX. Some quick stats to think about. CallDex and PutDex diverge on 42.2% of all trading days. We know that now. Of those days, CallDex is higher and PutDex is lower 52.9% of the time, and CallDex is lower and PutDex is higher 47.1% of the time. What does this divergence mean for the S&P 500 index itself? Can we use it to trade? We certainly can. If CallDex is higher and PutDex is lower, the average for the next day's change in the S&P is a gain of 0.07%. If CallDex is lower and PutDex is higher, the average of the next day's change in the S&P 500 is a gain of just 0.02%. This divergence provides insight that can help you become a better trader, and all of our index values are available in real time, including PutDex and CallDex, at nationsindexes.com. We're still in beta there, and we'll be rolling out a much improved charting package in the next few weeks, but use the coupon code diverge for a 50% discount on your membership at any level for the next 3 months. This offer ends on August 31st, 2025. There you have it. Portions of the S&P 500 option skew diverge more often than you would think, and you can use that information to become a better option trader and to make more money. I'm Scott Nations. Thanks for watching.